Gentlemen, if you would please take your seats. We don't want to fall behind. We have a very tight schedule. Our next panel is styled The Word from Wall Street, and the moderator is Tom Michaud, Chairman, actually President and CEO of Keefe, Bruyette and Woods, and a Director of the Foreign Policy Association. Tom.
Thank you. Thank you, Noel, and thank you everybody for joining us today. I think that first panel was very, very interesting, and thank you all for your comments. It's my honor to moderate the panel today with this group of individuals that's up here. Let me quickly introduce them, and we can get right into some very interesting topics. Our goal this morning is to focus on the United States economy and the U.S. markets. The U.S. economy is the world's largest, and as someone who's been participating in the markets for 25 years, I can tell you that never have macro issues mattered as much to stocks than they do right now, at least in our studies. We've noticed that correlation has grown substantially amongst equities, and what you'll find is that big events will happen around the world, and it'll affect all stocks equally, more so than it has in the past. So when you think about the U.S. markets, you need to think about some of these big macro issues that we had been talking about earlier and that we are about to talk about. But I am honored to have to my left Dick Peach. Dick is Senior Vice President in Macroeconomic and Monetary Studies at the Federal Reserve Bank of New York. He participates in the development of the bank's forecast for the U.S. economy, and he oversees the bank's projections of federal receipts and outlays. We're interested in all that, Dick, by the way. He's had a distinguished 20-year career at the Fed. He has a PhD and Master's in Economics from the University of Maryland. To Dick's left is Mark Zandi. Mark is Chief Economist of Moody's Analytics, where he directs economic research. He's also co-founder of theeconomy.com, which Moody's purchased in 2005. Mark's broad research interests encompass macroeconomics, financial markets, and public policy. His recent research is focused on foreclosure mitigation policy and the determinants of mortgage foreclosure and personal bankruptcy. His analysis includes the economic impact of tax policy and government spending policies. He's also the author of the book Financial Stock, a 360-degree look at the subprime mortgage implosion and how to avoid the next financial crisis. And his forthcoming book is Paying the Price, and provides a roadmap.
Okay, Tom, it actually came out last week.
It did.
It did. And I saw on Amazon the price is falling. So maybe you can help me out there.
As an economist, does that have anything to do with supply and demand?
I don't know. Amazon must have some algorithm, you know. It's not a good sign, though, that the price is falling. Yeah.
All right, so cutting edge book.
Yeah, cutting edge. Yeah.
Cutting edge book. And he's earned a master's.
And if you want to, an antidote to David Malpass. David, I'm sorry for he's awfully pessimistic. Read my book; it'll make you feel a lot better.
Wow. Okay. Well, we're going to dig into more of that. And Mark, you have a master's and PhD from the University of Pennsylvania. All the way to my left is Dan Ryan. He is chairman of PwC's Financial Services Regulatory Practice and a member of the firm's financial services leadership team. He's also one of our hosts today, so thank you for that, Dan. He advises some of the world's largest banks on matters ranging from business strategy and merger and acquisition activity to governance, risk, and regulatory issues. All things that I can tell you in my business, I know that these managements and boards are spending a lot of time thinking about. Most recently, he spent the majority of his time advising the global SIFIs, we can talk to him about that, on the Dodd-Frank Act and other global regulatory reform matters. He also has a distinguished career in investment banking and was a founder of a trading technology firm that is now part of NASDAQ. And Dan received his MBA in finance from Columbia University. So that's some background. So when you think of questions, those are the gentlemen and their expertise who are here today. Why don't we start with Dick? Dick, you work at the New York Fed for developing the economic forecast. I was hoping for this panel, since we talked about the importance of macro issues, maybe you could give us an update as to where the U.S. economy is today and what you think are some of the key emerging trends that are most noteworthy.
Okay, well, I'm going to pick up where the other panel left off, with some discussion of where the U.S. is at the moment. And let me say that we've had about 3 years of positive GDP growth since the end of what economists are now calling the Great Recession. But over that time period, the economy has only grown at a compound annual rate of 2.2%. And this chart that I've put up here gives you some perspective on what that means for the employment situation in the U.S. economy. We think that the economy's potential growth rate is right around that 2.2 percentage rate. So there are 3 time series presented in this chart. One is the headline unemployment rate, shown in red. The blue line is the labor force participation rate, or the number of people who are employed or actively looking for work. And then a less widely followed indicator is simply the employment to population ratio, the number of people who are employed divided by the civilian population. And as you can see, this growth that we've experienced has, all it's done is really stabilized this employment to population ratio. Employment growth is keeping up with population growth. And the main reason for the decline of the unemployment rate is that people have been leaving the labor force. So this, I think, summarizes in a very stark way what's going on with labor market conditions within the U.S. They simply are not good. Now, people have said, well, the quantitative easing by the Federal Reserve didn't work, and our response is, well, relative to what? What would the counterfactual have been? And we feel that while clearly quantitative easing didn't produce a robust recovery, it did ease financial conditions and make the performance of the economy better than it otherwise would have been. So the previous panel talked about fiscal consolidation, and it's happening in the U.S. In fact, it's been happening in the U.S. For a couple of years now. Let me walk you through this particular chart. We like these charts at the New York Fed. We call them spider charts. Along the horizontal axis, we're measuring time. And point 0 on that axis is the NBER business cycle peak. We then index some macroeconomic time series to equal 1 at that business cycle peak. So we can compare how that macroeconomic indicator is behaving during the current business cycle, which is shown in green, versus previous business cycles. So the green line is the current combination of federal and state and local spending. Now, this particular category of spending is not the transfer payments that the government provides to the household sector, but it's mainly employment and what governments, institutions spend on new trucks and cars and buildings and those sorts of things. And what you can see is it did grow for about the first 8 quarters of this expansion, but since has been declining and is likely to continue to decline for some time going forward. One of the reasons that it's likely to continue to decline, not only is the federal government now scaling back overseas military involvements, but this chart shows you what's happening to receipts at the state and local government level. These are year-over-year percent changes. The red line is total receipts for state and local governments. The blue line is tax receipts. The green line is federal grants and aid. And what has happened, you see the big surge in federal grants and aids. That was the result of the stimulus bill. But now that particular category of receipts is declining. Tax receipts are in positive territory, but not particularly robust. So the total resources now of the state and local government sector are back into declining. So they're not going to be in a position to do much for us. This is the same kind of spider chart, but in this particular case, we're looking at real business, non-residential fixed investment. This is what businesses are spending on equipment, software, and new structures. The green line is the current cycle. Very, very low. We had some growth, but if you look at the slope of the green line, more recently it's begun to level off. People often cite the fiscal cliff as a reason why businesses are pulling back. I think that's one reason, but I'm not convinced that it's the only reason. And then I'll just wrap up by showing a chart which the previous panel referred to. This is a chart showing private and public balances. Let me explain what this is. Again, this is strictly national income and product accounting. The economy can be viewed as divided into four sectors: the household sector, the business sector, government, and then the current account or the external sector. And this is, each one of these lines represents the saving investment balance for that particular sector of the economy. In other words, how much they're saving minus how much they're investing. Now, look at the time series, the long time series of the household sector. The household sector traditionally is a net provider of funds to the capital markets of the U.S. economy. We went through a period from the late 1990s to the mid-2000s where the household sector became net dissavers, and we saw what happened as a result of that. So the household sector, as was mentioned, is back into a position of positive saving, and the green line is now above zero. The blue line, the business sector, has traditionally been a net dissaver, a modest dissaver in the U.S. economy of about in the order of maybe minus 1% on average. But you can see that the blue line, the business sector, has moved way into positive territory. Major savers now for the U.S. economy. The green line, as was mentioned, the red line, the government. Government's typically a dissaver, became a very big dissaver during the financial crisis and the ensuing recession. Now we're trying to get this red line to move back up towards zero. And what we need is the blue line or the green line to move down towards zero, or the current account deficit to move up towards zero, in order to be able to achieve this fiscal consolidation while at the same time keeping the economy operating around full employment. And that's the rub. That's where we're stuck at the moment. And it's difficult to see what's going to happen. Certainly resolution of this fiscal cliff, I think, will be a positive. But again, if you look at the longer term trends about investment in the manufacturing sector of the U.S. economy, the non-durable goods manufacturing sector has been letting its capital stock roll off for quite some time. The durable goods sector has been expanding, but mainly in two categories: automobiles and aerospace. Most of the rest of the other durable goods sector of the economy is also letting its capital stock roll off. So, my bottom line is that whatever we do on fiscal policy going forward, we have to be very cognizant of the fact that we must make the U.S. an attractive place to invest. And that's got to be a big part of how we address this fiscal cliff issue. So I'll stop there.
And by invest, do you mean on the part of households and businesses? Do you mean globally? How would you further define?
Well, I mean business investment in not only in the service sector but in the manufacturing sector, and that's going to give workers the capital to work with, and to keep productivity growth strong, and to keep incomes growing at a decent pace.
And when you think of the type of just policy actions that could be taken to create those incentives, what's amongst the list of things that could be thought about?
Well, without getting into a whole lot of specifics, we have a lot of competitors around the globe now. That wasn't the case in the 50s and the 60s. And they have moved in the direction of reducing their taxation of capital, of trying to make energy less expensive. I heard a presentation just last night about how China's one of the long-term goals is to make sure that their electricity per kilowatt hour is one of the lowest in the world. This is a very important issue. So these are the kinds of things that we really need to address.
Terrific. When Mark, I know that you have actually written a book about policy responses to some of these issues. We don't have time to go through the whole book, but Dick's done a fabulous job of setting us up for the challenges that the economy has. When you think about the policy responses, is there any clear direction that you think that the markets would be most rewarding of in terms of actions that they would like to see?
Well, Tom, thank you for the opportunity, and Noel, thanks for the opportunity to be in FPA. I really appreciate the opportunity. Well, I think it's vital that the next president and Congress address 3 issues quickly, meaning first 3 months of 2013. The first is, and Dick has already mentioned it a couple times, is the fiscal cliff. We have to address that. Does everyone know what the fiscal cliff is? Okay. No, you don't know? Okay. So the fiscal cliff is under current law. If legislators do nothing, then we have very large tax increases coming. The Bush era tax cuts expire. And we have very large spending cuts in law. If you add it all up, it's over $700 billion in 2013, next year, which is 4 or 5% of the nation's GDP. That's a big number. And it's very clear if we actually go over the cliff, if there's no change to policy, we'll go back into recession. And it likely will be a very severe recession because there is no policy response. Because the Federal Reserve has really got its foot on the accelerator, and almost by definition, fiscal policymakers, the next president of Congress, won't do anything. So we have to scale that back. Legislators have to scale that back. The second issue is the Treasury debt ceiling. So that was alluded to earlier. That is, we can only, under the law, we can only borrow up to a certain amount, 16.4 trillion. If you do a little bit of budget arithmetic, we're going to hit that 16.4 trillion early next year. And the Treasury has ways to get around it for a month or 2. But my guess is that on March 2nd, 1 p.m. Eastern time, there's no other ways around it. That becomes binding. So we have to increase that again. And then the third thing is, and this is important for our long-term health, and this is how I would have answered the question about what do we do to get businesses to invest more, is we need to lay out a credible path to what you might call fiscal sustainability. That is, the government spending cuts, tax revenue increases that have to occur over the next decade or so that will result in budget deficits in the future that are small enough that our nation's debt to GDP ratio, that's our debt load, stabilizes. Right now it's rising very rapidly. That's not going to work. We have to stabilize that. And we have to do this credibly. If we don't do this credibly, then the rating agencies have come out and said that they'll downgrade the debt. That's not a good thing. But more importantly than that, investors are going to say, you know what, we're just not capable of addressing our fiscal problems without a crisis. And you know, the crisis won't hit next quarter, next year. I don't know when it'll hit, but it'll be a pall over the economy. People, businesses won't feel comfortable about taking risk. They won't be comfortable about investing in our competitiveness. It'll undermine our economy, long run. And ultimately, at the end of the day, there will be a crisis. So we have to do these 3 things, and we have to do them early next year after the election. Now, it's easy to construct very dark scenarios. You know, this is politics, and we're beating each other over the head. Very vitriolic kind of discussions in Washington. But I actually think the political stars are aligned that we're going to get a deal that will reasonably, gracefully address these 3 fiscal issues. And I'll end this way. I won't tell you how we're going to do that, unless you ask. But if we do that, and again, I think odds are we will, I think our economic future is incredibly bright. I think American companies are in tip-top fighting shape. Their balance sheets have never been stronger, at least in the data I look at. Not every company, but in aggregate. They're highly profitable. Profit margins have never been wider, at least in the data that I look at. American banks are highly capitalized. They've raised a boatload of capital. They're very liquid. They're in fighting shape. And I think even American households have made a lot of progress. I think balance sheets for most Americans are pretty good. So we're raring to go. We're very competitive. We just need to nail down these fiscal issues, fix Dick's red line, at least move in the right direction. And we're going to be fine. We're going to do very well.
There was a proposal to address this. It was the president's commission, the Bowles, sometimes referred to as the Bowles-Simpson Commission, which came out and laid out a couple of principles for I think a multi-decade approach to fixing some of these issues. And then I think it's also been referred to at times as the grand bargain, which I think is maybe what you were talking about. Could you maybe lay that out and to the degree that maybe you have some insights that could happen? I happen to personally agree with you that could be a very powerful catalyst, because I think what we heard from the earlier panel is that many of the European issues are going to take time, whereas this could be a pretty powerful catalyst next year. Your thoughts around that?
Sure. So Simpson-Bowles, this is Simpson, Wyoming Senator Bowles in the Clinton administration, very well respected Democrat, came together and formulated a credible budget plan to achieve that third issue, to address that third issue of fiscal sustainability. What kind of government spending cuts, what kinds of tax revenue increases do we need to get those deficits in the future small enough that our debt to GDP ratio stabilizes and starts to come down? They came forward with a proposal. There's a lot of debate as to why we didn't adopt the proposal. But my guess is that we're going to adopt something very similar to that after the election. It's a very, Simpson-Bowles provides a very nice framework for, what kind of spending cuts. Obviously, we have to focus on entitlement, our entitlement programs, the Medicare system, the Medicaid system, the Social Security system, and also what kind of tax revenue increases. And that involves tax reform, meaning how do we, and this gets to a point Dick was making, how do we reduce the loopholes in the tax code, the tax expenditures in the tax code, to generate enough revenue to address our fiscal problems, but also hopefully lower tax rates on businesses and make our businesses more competitive and make them more interested in investing in the United States than investing somewhere else. So Simpson-Bowles is this broad kind of outline framework with some detail, but enough detail that I think we can all get around it. And this is one reason I'm optimistic. Everyone is now bought into this, right? I mean, Simpson-Bowles, everyone, all the policymakers mostly have. And so I think that's very encouraging that, both Republicans and Democrats, when you hear them talk about this, they say Simpson-Bowles. And so to me, that's a very positive step and something we can all rally around. And I think we will after the election.
So your sense is that if we get some type of a policy response on the fiscal side, it can unleash some of that business activity, that, as Dick said, to bring that line down and get the businesses active again. That could be a stimulus for the economy.
Absolutely. At this point, we have righted so many wrongs. We had a mess before the Great Recession. You go back 07, 08, we had overborrowed, our banking system was undercapitalized, we were a mess. Our balance sheet was a mess, private sector balance sheet. We have made enormous strides over the last 4 years. Our balance sheet, our private sector balance sheet is, it's not hyperbole, in my view. It's as strong as it's ever been. We got a few problems I'd love to nail down. Student loans are a problem, but in the grand scheme of things, that's small. We still have some loans in the foreclosure process that we're working through, and that would be very encouraging to work through that more quickly. But outside of that, our balance sheet is very good. And the only thing we're missing, the missing ingredient, is confidence. That's it. That's it. That's the only thing that's holding us back. And if we can nail down these fiscal issues, I am confident that we are going to feel much better, and we're going to be off and running. And the surprise is going to be how good things go, not how bad they go.
Mm-hmm. Interesting.
I'd like, before I
Please.
have to say one thing about Simpson-Bowles. Everyone talks about it, they say nice things about it, but there's some reality to it, and that is that for most of the post-World War II period, federal revenues have averaged about 18.3% of GDP. Under Simpson-Bowles, they rise to, what is it, 21, 22% of GDP, and this is achieved primarily by scaling back the mortgage interest deduction, taxing the health benefits that employees receive from their employers, scaling back the deduction for charitable contributions. I think it's one of these things where people say a lot of nice things, but when the rubber hits the road, it's going to be very difficult to enact.
Well, should I respond?
Sure.
Okay.
Makes my job a lot easier.
Yeah. I'm not saying this is easy. This is not going to be easy. I don't think the numbers are as overwhelming as Dick laid them out. You do a little bit of arithmetic. We need $3 trillion in deficit reduction over the next 10 years to get to fiscal sustainability. Simpson-Bowles, in part because people don't realize this, but we did get something good out of the Treasury debt ceiling debate back last summer. And as we agreed to $1 trillion in spending cuts over a 10-year period. So it's not like we got nothing out of that. It was a very ugly period, but we got something out of it. So we need $3 trillion, roughly speaking. You can debate the numbers, but I think that's a good bogey for us to aim for. Simpson-Bowles would say, roughly speaking, you need $2 trillion in spending, $1 trillion in tax revenue. It's not very difficult to get the trillion. I mean, it's difficult, but everything's difficult when it comes to taxes. But it's very doable. It's very doable. I'll give you a sense of it. If you allow the tax rate on folks that make over $250K a year, this is what President Obama has proposed, and by the way, very likely to happen, regardless of who wins the presidency. That'll generate about $500 billion over a 10-year period. So you're almost halfway there. The mortgage interest deduction by itself is $100 billion a year. You scale that back by half, you're done. You hit the bogey. And the mortgage interest deduction sounds like that's a road that no one wants to go down, but I think that's a road we're going down, right? Because you can do some very simple things to that, like turn it into a tax credit and limit it. Turning it into a tax credit for everybody. So not just people who are higher income who deduct can take advantage of the mortgage interest deduction, which helps people in the middle and high income groups. But a tax credit for everybody so low income households can benefit from it as well, which I think is reasonable and fair. And you do that, you cut it in half, you raise $500 billion over 10 years, done. So, I wouldn't let the perfect be the enemy of the good. We may not get this exactly right, but we got to just get it directionally right. And if we do that, we'll get into a much better economy. And once the economy turns, good things happen. These budget numbers, people don't recognize this, but you change the economic outlook by 1/10 or 2 on GDP, that's the value of all the things that we produce. That rises 0.1% faster than we're assuming in our budget. The whole budget picture changes very rapidly. So we just need to get moving in the right direction.
Yeah. And part of what you said earlier, I think, is, and what you two were just talking about, are intended and sometimes unintended consequences of these policy actions. Let's talk a little bit about the quantitative easing that's going on. And again, thinking about investors. What are the implications of this and to investors, especially when you think about bubbles? Is this quantitative easing policy creating the next bubble? And if I mentioned earlier in much of your work, you've looked at bubbles. Is there another one out there building?
You want to ask out Dick?
Well, he works at the Fed. He works at the Fed. We don't want to get in trouble.
I'd love to hear what he has to say. Yeah.
We'd love to know what he thinks, but I'm not sure how far out he can get on that. So you might be the best on that.
Okay. Well, I think quantitative easing is an appropriate policy at this point in time. I think it is a meaningful positive for the economy. It's not a slam dunk positive. There are negatives, but on net, this is a positive for our economy. I do sympathize with folks that are concerned about how the Federal Reserve is going to navigate through this down the road when they have to take it back, when they have to drain the liquidity. But I think that the Federal Reserve has the tools, the acumen, and the time to do this reasonably well. But they may not land the inflation plane right on the tarmac, so to speak, but they're going to get it pretty roughly right, I think. Because ingrained in the DNA of the central bank is that we have to keep inflation low. You know, if we don't keep it low, we got a world of hurt on our hands. So I don't think they're, it's in their body.
But when you look at other asset classes, even away from just that policy, do you see anything building in any other?
No, I don't. Maybe gold, but who cares? You know, it's not a macroeconomic.
Let me ask this question. How about if you follow the mutual fund flows, the American investors have been piling into fixed income mutual fund instruments and leaving equities. When interest rate policy starts to go the other way, is that something that could potentially endanger a recovery?
Yeah, but that's not a bubble. I wouldn't say it's a bubble. I mean, bubbles generally are speculation fueled by leverage, and we're not talking about that. You are bringing up a good point, though, and another potential downside of quantitative easing in the future, and that is when rates start to rise, how do we all adjust to that, right? Because you know the banking system, there's probably someone out in the financial system who's betting on low rates for a very long time, and they're going to get surprised, and there's going to be some kind of financial event. Households could get surprised, so there is going to be adjustment. Now the Federal Reserve has come out and said, Chairman Bernanke has come out and said last couple of weeks ago that when rates do rise, rates are going to rise relatively slowly, hopefully give people time to adjust. I'm not so sure tactically that's the right approach. I'm not sure I would have taken that approach for lots of different reasons, but he's trying to let everyone know, you know, you're going to have time to adjust to this once I begin. So he's thinking about this as well. But again, that's another potential downside down the road, but that's not a bubble. That's not a bubble. And
before we move on to Dan, so you said what could happen next year. You mentioned what could be a positive surprise if we get some type of a grand bargain fiscal response out of Washington. What do you think the stock market's expecting in the U.S.?
In terms of the fiscal issues?
Just when you measure sort of the value embedded in the stock market.
The stock market, I think fixed income investors are expecting policymakers to get this roughly right. I mean, you know, if you look at the S&P or PEs, you look at junk corporate bond spreads. Some of it is juiced by what the Fed is doing, so it's probably masking some underlying concern. If the Fed wasn't doing this, PEs would be lower, credit spreads would be wider. But I think investors expect policymakers to get it together. And I'll end this way: that that's the right forecast because that's our history, American history. When push comes to shove, we figure it out. Right? It's pretty messy when we are in the middle of it, and it feels ugly when they're in the middle of it. But we get it done. I was just upstairs doing the PBS interview, and the guy, we're just chatting, the camera guy, and he's saying, "Oh, when President Clinton was president, it was so bipartisan. We were able to get it all together. And you know what? Do you remember back to the 1990s? I mean." The president was impeached, literally impeached. I mean, there was nothing bipartisan about it, and we nailed it down. So, Alexander Hamilton and Tom Jefferson, have you gone back and looked at what they were writing in the newspapers back then? Well, they were using each other's, all kinds of sexual problems. I mean, it was like no holds barred kind of stuff.
Yeah.
This is the American experience, and when it comes down to it, we figure it out. And so, if you're an investor, you make everyone forecast based on history, and the history says we get this done, and we're going to get it done.
So, if you hear that, that means that you might see better economic growth coming down. You would be encouraging then to a potential equity investor to look at stocks based on that. Is that a reasonable conclusion?
Yeah, I think. I have strong convictions about many things I say. I have less convictions about lots of things I say. And when you're pushing me into predicting stocks, I have less conviction. But let's put it this way: I am 53 years old. When you're 53, you should be thinking more fixed income. And the guy who manages my money says you should be thinking more fixed income. And I'm saying no way. I'm equity.
Especially at these interest rates. Dick, did you have anything else that you'd want to add to that before we
very
move down
quickly, I just wanted to say something about quantitative easing. It has a different name, sounds extraordinary, But in fact, mechanically, it's the way monetary policy is always conducted, not only here, but around the globe. The central bank goes out and buys the safe asset to encourage households and investors to start moving out the yield curve and moving out the risk curve. And the problems of rolling back quantitative easing are no different than rolling back an easing of monetary policy when the federal funds rate is in positive territory. So we've confronted these issues many, many times before. And what I should also mention is that the Federal Reserve now has a tool that it never had before, and that is the tool of being able to pay interest on excess reserves. Right now that's 25 basis points, but without beginning to extract reserves, it could change the incentive structure for banks about what to do with those reserves by raising this interest rate on excess reserves. So I wouldn't, I mean, I know that there's a great deal of concern about that this is an inflation policy and stuff like that, but really when you look at it from a longer term perspective, a broader term, it is just monetary policy.
Okay, thank you very much, gentlemen. Dan, you're an advisor to many of the world's global SIFIs, which are the strategically important financial institutions, especially those in the United States. We've just come through a period with probably one of the greatest increases in regulation on the industry as a response to the global financial crisis. In particular, you've got the Dodd-Frank legislation, and then you have the Basel III International Banking Accord. If you were to measure the time length of implementation of how much of it we've actually seen, where are we in the process? Are we still early in the process? Are we in the middle? Are we near the end? And I would assume during this process, as it plays out, the financial institutions are adjusting.
Yeah, I mean, tomorrow will be 4 years since Lehman fell, and we're about 2.5 years since Dodd-Frank was passed. I mean, and Mark pointed out that the banks themselves, U.S. banks, are actually very healthy. They have twice the capital that they had during the crisis. They're substantially liquid. And so that said, the regulations are really just starting. So it's kind of odd. We had a supervisory reaction, which was we had the crisis. The regulators got very involved, forced the banks to raise capital, forced them to deleverage, forced them to get liquid, right? Then 2 years later, Barney Frank and Chris Dodd decide they're going to put in a whole bunch of regulations, right? So you kind of, in many cases, the regulators took the initial actions to kind of respond to the crisis and fix the banks, and then the politicians jumped in with new regulations to make things better. So in terms of Dodd-Frank, which is 2.5 years old, we're only a third of the way there. So about a third of the rules have been issued. A third of the rules are still pending, so meaning there's a draft that's out there, but they haven't actually been issued. So the Volcker rule is a perfect example of something that's talked about all the time, but there really is no rule yet. Then a third of them have not yet even been written. So if you look at where the end of this process is, as it stands now, it's got at least 3 to 5 years to run before all the rule set is laid out for the U.S. In Europe, there are no reforms on the table, realistically, although we expect some this year, at least the first round of that. And then in Asia, we'll see where that plays out. So if you're a bank CEO, you're basically sitting here saying, I raised all this capital, I'm highly liquid, I've reduced my risk taking substantially, but I have no idea in the next 5 to 7 years exactly what the rules are going to look like in which I need to do business. So I think that's a lot of what, when you hear in the press that the banks aren't lending and that the banks are a lot of the holdup in the crisis or in the current situation, it really is this kind of uncertainty in terms of how are things going to play out in the future. So we're really only a third of the way there. And the Basel rules, which you talked about, really don't kick in until kind of the end of this decade, more or less, and would require the U.S. banks, who are already the most well capitalized in the world, to raise at least 25 to 30% more equity in the future. So,
do you think that these rules and regulations are going to change the business model? And first of all, maybe I would ask, is it different for like the big 6 bank holding companies in the U.S., which are the big investment bank 6? Is it different for them than the rest of the industry? And are they going to look very different 2 to 3 years from now?
Yeah, this is one of the topics we have too, is everybody says, break up the banks are the problem, but there really are 6 banks in the United States who are, dominate the landscape and are critical to Wall Street and the flows of capital. The other banks largely go about traditional banking activities in terms of the way things play out, so it's very important to kind of segregate out the big 6 from really the rest of the landscape. The odd thing about the regulations, once again, they're written by politicians, not by regulators, is that the bigger are going to get bigger. So absent any action to the contrary, the reality is those folks who can actually best spend money on lawyers, consultants, technology, afford to hold additional capital, and be liquid are the biggest guys. So actually, in the way things play out, we see the pack splitting even further. So the only thing that'll play in this new world will be scale. And so the big will have to get bigger to actually kind of compete. And then you layer that into those 6 really compete globally. The good news is that they are well positioned to own the global landscape. So if you look at the way the US through Microsoft and Apple and the like own the technology landscape, we can really own the banking landscape globally in the next 10 years to come, assuming that some of the handcuffs get taken off of the banks in terms of doing business. I think the real big issue is we get caught up between the banks are too big, we need to break up the banks, and then the reality, which is banking is a core competency of the United States. It's something we do very well absent the crisis. Morgan Stanley employs more people than Apple, if you can believe it, in the United States. I think investing in the banks and investing in the banking industry is important to the U.S.
The subject of too big to fail has come up, and I think that the Dodd-Frank bill tried to create this process of a living will such that market forces could allow a big bank to fail without government intervention. If you have the big banks getting even bigger, does that mean that these banks will remain too big to fail? Or do you think that there is an orderly process to keep some market discipline on that growth?
Well, the real big issue in the crisis was we didn't have a plan and we didn't have information. So when the banks started to get into trouble, it was weeks and days, it wasn't months and years. So the regulators themselves didn't really have a plan for what to do in terms of the failure of Wachovia or Citigroup or something like that. And the banks themselves really didn't have enough information to try and say, all right, given this crisis, how do we act? So the living wills process has been very good about forcing the banks and the regulators to figure out the what ifs. How could we unwind this? What would we sell first? How could we possibly de-risk? What actions we could take? So really forcing them to kind of think through kind of a wargaming and scenario planning exercise. On the other hand, we're 5 to 7 years away from having a legal and bankruptcy framework where we could really take apart one of these large institutions, on a global basis. I'd say once again, the living wills is a good differentiator between what the U.S. has done and what the rest of the world has done. So in the U.S., we required the banks under Dodd-Frank to write their own living wills. Basically, you tell me how you're going to resolve yourself without government intervention. The rest of the world, the regulators are supposed to write the plan. So the banks and the regulators got together, they wrote their plan, they stuck it in the drawer, and no one actually could see it. In the US, we had some publication on that. There are actual bank plans out there. In the long run, this will help the US banks because it effectively will give them a license, almost kind of an insurance policy in which to operate. So if you're a bank and you want to operate in the global landscape, go forward, you're going to need a country, your home country, hopefully, to vouch for you and say you're safe to go about and do business. So once again, I think the U.S. banks are way ahead of Spain and France and the U.K. in terms of having their banks have the ability to operate outside their home borders. But in terms of these living wills are really going to be the answer to pull apart a large institution. We're light years away from being there.
And then along the lines again on in terms of the business model of the big banks, do you think that the bigger banks will return a little bit more to traditional banking? Or do you think that they will, when the markets improve, that their investment banking activities will resume?
Yeah, we got to where we got to on purpose. So, one of the things that once again, revisionist history, right? In the 60s and the 70s, banks were becoming largely irrelevant as corporations could access the public markets, through broker-dealers and investment banks. They were going around banks in terms of traditional financing activities. People as well, too, could open up accounts with their brokerage firm or whatever in terms of accessing cash and the like. So the fear was that all of the intermediary activities would be taken away from the regulated market and pushed out into the shadow system. And so the idea was, how do we kind of force it back onto the banks? Well, let's allow the banks to engage in other activities like investment banking, right? This was an intentional effort on the part of the U.S. regulators to actually improve the relevance and resiliency of banks. Now we're sitting here saying, all right, we've got to pull it apart. The problem is that while the banks expanded into many of the traditional capital markets activities previously owned by the investment banks and broker-dealers and the like, all those other firms are gone. So if you want to send the banks back to just do traditional banking, you've basically got to reform the rest of the capital markets infrastructure, which I don't see how we do that. So I do think that we're largely well served and stuck with the model that we have. I think the key is to just make it safer in terms of the process.
Well, thank you. I'd like to open it up to your questions. We have one right here from this gentleman. Why don't you go ahead and speak loudly until we get the mic moving around.
Right, so this is kind of directed to Mark and Dan. Mark, you didn't mention that there's about a $50 trillion, that's a conservative estimate, of unfunded liabilities when you put together government, military, pensions, Social Security, Medicare. So there's this big shift of debt from the private sector onto the government sector. The government is going to be faced with these liabilities. There's high levels of unemployment. So you have this problem in the government sector. A lot of people say, well, you know what, don't worry about someone else's grandchildren, just worry about my investment portfolio. But I see the banks having exposure to this government debt, and the banks being sort of the conduit of these problems in the public sector, carrying that into the private sector. So even though here in the United States, corporations don't rely on, say, bank loans, they still rely on these capital markets, that these financial institutions, they make those capital markets. So I am very concerned about how these problems in the public sector, including this $50 trillion unfunded liability, how that could impact the banks and how that could then transmit those problems in the public sector into the private sector.
Do you want me to take a crack?
Go ahead.
Okay. Well, thank you for the question. It's a very good question. Well, this goes to the need to address our entitlement programs, Medicare, Medicaid, Social Security being the most important. And a big chunk of the unfunded liabilities are sitting in these programs. So we need to figure out how to address that. So that's got to be part of the process. But let me just say that we don't have to solve it, the $50 trillion problem. And I'm not sure if that's the right number or not. I haven't looked at it recently. But yeah, we don't need to solve it overnight because this is a long-term problem, over the next quarter century, 50-year period. But we do need to get moving directionally in the right, moving in the right direction. So, and there's no way we're going to achieve fiscal sustainability, as I defined it earlier, without addressing the entitlement programs and addressing this unfunded liability issue. So, I do think that's part of the process. Just quickly on the banks, and I'm sure you might have a comment on this as well. First, I'd say, of all the things that banks can invest in, still, as far as we know right now, and looking for the foreseeable future, Treasury debt is the most rock-solid asset on the planet. And everyone on the planet knows that. If there is a problem anywhere on the planet, even if it's sitting in Washington, they buy the U.S. Treasury bond. So, I still think this. We deserve that because we worked hard for it for, beginning since Alexander Hamilton set it all up. We've been working hard for that, and we deserve it. We still haven't lost our resolve and our ability. At least we haven't yet. Our resolve and ability to address it. The other thing is, that, you know, if you look at a bank's, the U.S. banks, balance sheet, their holdings of debt are still, you know, Treasury debt are pretty low. It's not like, you know, Spanish banks and Spanish sovereign debt or Italian banks and Italian. We're in totally different universes, you know, at this point. So I wouldn't view that as a serious threat, at least not for the foreseeable future.
Yeah, I would agree. I think the bigger issue is the fiscal stability. So to the extent that China still holds the large portion of the debt, the banks don't have it, right? That's our biggest, you know, the biggest plus in this, and Europe's biggest minus is that the banks and the sovereigns in Europe are all intertwined, right? You can't transfer, but we're not close to that at this point.
I'd like to just
Yes,
get on my hobby horse here again. These entitlement problems, we're debating whether we address them through the revenue side or the expenditure side of things. And simultaneously, we're worried about the fact that businesses are not investing in the United States. So Canada is lowering their taxes, attracting talented people and capital in the process. So we gotta really keep in mind the fact that we want to keep talented people in the United States. We don't want them to go to Canada. We don't want them to go to China or to Singapore or all these other places while we address these entitlement issues.
Thank you. Yes, ma'am.
For Mr. Peach, in view of the high unemployment rate in this country, given the fact that the employment rate is very high in this country, never been so high, the Federal Reserve has indeed established a stimulus program. Why doesn't the Federal Reserve increase it so that we can repair the crumbling infrastructure of America? The roads are falling apart, the bridges are falling apart. Why don't we put out money so that we can employ people to work, which will give them consumer ability?
Right, well this, glad you asked that question. What you propose, I think, has a lot of support among economists, among the population at large. People that I speak with speak about the need to improve our infrastructure and bring it really up to a world-class standing. Unfortunately, that's not the purview of the Federal Reserve. That's a fiscal policy issue. Now, the Federal Reserve could perhaps help through the conduct of monetary policy to create an environment of low and stable inflation where the government could issue the debt to finance those sorts of activities. But the Federal Reserve really can't be seen as engaging in fiscal policy. There's a huge risk at that point that inflation expectations would become unanchored, and we could end up shooting ourselves in the foot in the process, because nominal interest rates, at that point, nominal interest rates might just shoot up and choke off economic activity rather than, you know, the intent is to stimulate economic activity. But you hit on a topic that I hear a great deal of support for, and a lot of wishful thinking that perhaps the stimulus bill of 2008, or even the Bush tax cuts, were an effort to stimulate economic activity. I think that's often lost in the discussion of them. Perhaps the mix of those could have been changed, where there could have been a long-term infrastructure component to that, and less in the way of tax cuts.
We have time for one more question, ma'am.
This is actually a follow-up to her question, because I work in the infrastructure industry. And I've been up in the Hill over the last couple of weeks to talk to various members of Congress and staffers on different tools. And yes, the Federal Reserve could put their 2 cents in. And the issue is around whether this country could learn to adapt a national infrastructure bank, whether this country could learn to adapt something called SPVs, special purpose vehicles, in which municipal infrastructure is jointly owned by the private sector in the version of private equity funds, private institutional funds that will be joint owners. So in your mind, all of you actually, and particularly the gentleman from the Federal Reserve, what can you guys really do to help get this argument moving forward in the right direction? I've already been challenged by certain members of Congress to put together a bipartisan discussion after the election.
Dick, would you like to handle that?
Well, my answer to the previous question was strictly in the realm of the conduct of monetary policy, but the Federal Reserve does a lot of things. The Federal Reserve includes probably the largest concentration of PhD economists in the country. They are engaged in a lot of research. We host conferences, try to be thought leaders on a lot of different topics. A week from this Friday, Mark is going to be joining us for a conference at the New York Fed on the distressed real estate issue, sort of taking stock of where we are and what sorts of policies we can do. So the Federal Reserve does lots of things in that sort of thought leadership realm that we may be able to apply to this particular issue. But as far as going out and saying the government's going to issue $100 billion of debt, and that's going to be financed by the Federal Reserve buying it, no, that's not something, that's not a path we want to go down.
Well, I would like to thank our panelists for joining us this morning. This was very interesting, and thank you for your questions.